You have to consider that to reach the lowest price level so far, there must have been more traders who thought the current price was more than its value. At the very least, they believe that so far, the most those who are ready to act on their beliefs that the price is high, and so they sell, where there are also traders who were interested in buying at an all-time low price. What you think about the value and the reasons for your belief can be of the highest quality, but if the market doesn't share your belief, it doesn't matter how right you are based on your superior reasoning process or what you think, because price moves toward the greatest power. Even a high IQ won't make you what it makes you in society in this environment. The trader, by trading, acts on their future beliefs, and there is only one force here that can move it forward by acting on the price, and this movement creates an opportunity to make money, and making money is trading. This is also true for Hazel trading to protect her asset value. Each individual trader here will define what market conditions are suitable for them. Any reason represents an opportunity to trade, no matter how much you misunderstand it. If the net result of the collective action of all participating traders raises the price against your conditions, then they are right and you are losing money. The market is never wrong. It just keeps moving. So you, as an individual trader interacting with the market, must first understand an opportunity as an observer, and then, and yes, the opposite never happens, as a trader, you have to decide what's more important for you, being right or making money, because the two are not always compatible or consistent with each other. So now, in Chapter 3 of Part 2 of the book, you have learned that the market is always right. In the next episode, we will learn about the unlimited potential of the market in Chapter 4 of the book. If you like this effort of mine, please let me know by commenting. Like it, and be sure to share it with at least 4 of your friends on social media. Thank you. In this episode of the Hindi audiobook, we talk about Chapter 4 of the Discipline Trader book, and how Mark Douglas explained the unlimited potential of profit and loss in trading. Let's know. Chapter 4. The most effective way to illustrate the unlimitedness of the market environment is to compare it to gambling. In any gambling game, you will always know how much you can win or lose each time you play. You can decide how much you want to bet. You know how much you can win and lose, and you can also know the mathematical odds or obstacles of any possibility. This does not happen in the market environment. In a particular trade, you never actually know how far the price will go from a given point. If you never actually know where the market can stop, it's very easy to believe how much you can earn in a trade. From a psychological perspective, this feature will allow you to be under the illusion that every trade has the potential to fulfill your biggest dream of financial freedom. The consistency of the ratio of buyers and sellers of market participants and to move the price in your direction, although if you think this is happening, your nature will only be to collect the kind of market information that will nourish and reinforce your belief. When denying that vital information that can give you the best opportunity, they are the opposite direction. If you are in a losing trade, the market can move further and further away from your entry point, which can increase your potential loss. Although this is happening, instead of dealing with the possibility of the market continuing against your position, you can only imagine that it's coming back in your favor. This kind of thought process will continue until the horror of the loss takes over you, and the possibility of increasing loss suddenly becomes more relevant than the possibility of the market returning. Finally, you get out of the trade. You never thought and will never think that you can allow yourself to suffer such a big loss. From a psychological perspective, when you imagine earning all the money you ever wanted to earn, the possibility of unlimited profit, happiness, power, etc., whatever it means to you, can be extremely dangerous. The possibility can actually exist, but how realistic it is in a trade is a different matter. There are many psychological factors that are able to correctly assess the potential of market movement in a direction. One of them is to free yourself from this idea, a major obstacle to learning how to understand market action. Otherwise, if you constantly filter market information in such a way that your belief can be confirmed, then learning to be objective will not be a concern, because you probably have to trade. So now we have learned about the unlimited potential of the market in Chapter 4 of the book. In the next episode, we will learn about price movement in Chapter 5 of the book. If you like this effort of mine, please let me know by commenting. Like it, and be sure to share it with at least 4 of your friends on social media. Thank you. In this episode of the Hindi audiobook, we talk about Chapter 5 of the Discipline Trader book and what Mark Douglas has to say about the market's movement. Let's know. Chapter 5. The price is always in a perpetual motion which has no defined beginning or end. The market is always in motion. It never stops. Only we stop. As long as there are traders who are willing to buy and sell at a higher price than the previous price for some reason, and as a result bid higher than the price will remain in perpetual motion. Even when the market is closed, the price is theoretically in motion.
For example, it is not necessary that the price at which the trader is willing to buy or sell at the time of opening the next day, but it is also not necessary that the market is at the price level where it closed the previous day, which is usually considered as 3 common decisions of entry, hold, or liquidity in a trade. It becomes a perpetual process to decide how much is enough from both profit and loss perspectives. If you are in a profitable trade, is it enough? Greed arises from the belief that it will never be enough or will never be enough. In an unlimited environment, which is in perpetual motion, isn't there always a possibility to get more? The hunger for true greed can never be satisfied. It will keep greedy people afflicted with a sense of lack no matter how much they have achieved. If you are in a losing trade, then you won't want it to exist because it represents negative. So you can just act as if it's not there, reassuring yourself that you are in a winning trade that is not yet in your favor, it's just about to come. How much is enough? This question can be answered in many ways related to your belief in the value of money. What you need it for, how important it is, whether you can actually risk it, how secure you feel, and what is enough today may not be enough tomorrow due to other factors in your life. All are relative questions which have no definite answer and change with changing environmental conditions. As a trader, dealing with these personal issues will only worsen your comments about the market's movement, because they have nothing to do with the market's direction and the capacity or lack of a particular market move. This is why successful traders have always strongly said that you can only trade with money that means that money that has very little or no value in your life. The less the value of the money, the more likely your personal how much is enough issues are to worsen your perception of market movements, and will always give you something to prove your hope right that it will come back and complete you. If you are in a losing trade, falling into one of these temptations can be a possibility of perspective and painful consequences. The market environment is also so unstructured that from a psychological perspective, there is no beginning and no end. From this event, the market wants to say that from a personal trader's perspective, the game only starts when you decide to enter and ends when you decide to exit, regardless of whether the market opens and closes. You have the freedom to create this game in a special way inside your mind. You can participate in it for any reason you want that is enough to justify your actions, and you can exit whenever you want. In reality, this game ends only when you have decided that you have had enough and take appropriate action to end it. Dealing with these conditions has a surprising psychological impact on the person. All your ideas related to the opportunity to enter a trade, missing out, the need for a specific thing, and not being wrong will be included. Keeping in mind the unlimited possibilities of profit, it will be very easy for most traders to enter the market than to exit. This is because to get out of a trade, you have to deal with your ideas about greed, loss, and weakness related to the endless temptation of the possibility of unlimited profit. These individual psychological issues are completely independent of objective market action. And more importantly, as Mark will explain to you in Part 3, your ideas about loss, being wrong, negative, and control will operate independently of your conscious intentions. For example, think about the last time you made a profit and the fear of being wrong or losing, etc., froze you, which made you avoid trading. To the extent that these issues are present as a component of your mental environment, they will determine their effect on your perception of market activity, the decisions you make, and your ability to act on the decisions you make. Although related to this new beginning and never-ending feature of the market environment, one of the most important and potentially harmful factors is that it allows you to be a passive loser. The best way to clarify this idea is to compare the market to any kind of gambling. For example, with blackjack, roulette, or craps, the player has to make a conscious choice to play, and from the event, he has to decide how much he will bet. The event starts and ends according to the rules of the game, and the risk of loss is limited to the size of the bet. Each new event is a new beginning, where the possibility of winning can be determined by mathematical possibility, and the rules of the game automatically get the player out after each event. When the game ends, the player has to know exactly what the result will be, and then he has to make a conscious decision to participate again. Therefore, the structure of the game forces the player to be an active loser.
It is necessary for him to put a specified amount of money to put a bet under the possibility of losing more than the money already lost. He has to actively participate in losing in it and not do anything to stop losing. Certainly, if the player does nothing, he will not put his assets under the possibility of loss. If the player, because he can always argue that based on the obstacles he is created to win, and he will always quit playing after the next game. But to end a particular game, he does not need his mental structure because it is automatic. This is very different from the market environment where you can be a passive loser. Once you start a trade, you have to actively participate to end your losses. You don't need to do anything to keep losing, and the market can go against you indefinitely. If for some reason you prefer not to act or are unable to act, you can lose everything and even more. Based on the size of your position and the volatility of the market, this can happen very quickly. The only way is to deal with your personal issues about greed, loss, and negative. Which specific issue or combination of them comes into play in each trade depends on whether you are in a winning or losing position. Since we all easily avoid dealing with any such issue that can cause pain, such as getting out of a winning trade too early, or admitting that it was our mistake to get out of a losing trade. This, therefore, in any case, we will not have any reason to deal with those inner forces that prevent us from objectively understanding that the market about the possibility of profit and possibility at any time. The market makes it very easy for you not to deal with these extremely difficult psychological issues. For example, if you focus your attention on market movements at a tick-by-tick level, the market can graphically present billions of combinations of characteristics and value patterns used to move from one point to another. It is very easy to use this type of information to support any belief, rationalist, justification, distortion, or illusion that you want to know where it is going in the future. Most traders will try to make this price movement easy by thinking that the price can only do three things. It can go up, it can go down, or it can basically stay the same as they are. Some traders can also take this distorted logic to the point where they think that the possibility of success in a trade is 50-50. Undoubtedly, this can be very far from the truth. For example, assume that the price was within a 10-tick trading range for the entire trading session. If you keep each tick in mind, how many value patterns can the market present from the top to the bottom of the range and then again? Here, Mark says that he is not a statistician, but he is sure that it is at least in lakhs. To make it a little clearer, if point A is at the lower part of the limit, then the price can change one tick up, two ticks down, one tick up, three down, two up, one down, one up, three up and down. This is clearly a very small version of the method of increasing the price on average, but it is represented by a pattern among millions of possible patterns, combinations, and each pattern identified by you can repeat itself in the future at some points. If you are buying at point A, what is the possibility that the price will be above your entry point? What is the possibility that tomorrow or the day after tomorrow, the price will go above 2 ticks, 5 ticks, or 10 ticks without going below your entry point or return above your entry again? Once the price goes below your entry point, what is the possibility that they will never go above your entry point? What is the possibility that they never go down? To answer these questions, you need to know a lot about the market's stability and its ability to act in some special ways. In any case, to deal with this type of movement, with respect to the emotional nature of most traders, and in this context, most people think about 50-50 odds. This certainly does not apply to the market. To clarify another point, if you get halfway between point A and point B, which tick will you tend to give more weight in terms of market information? Yes, the tick naturally goes down. They confirm what you think, and now they don't tick, yet each of them related to each other can tell you something about the market's stability and its ability to move in any direction. If you specifically give more importance to the information that confirms what you want or believe, then how can you start correctly assessing that capacity? In reality, you are using the information in accordance with your hopes, dreams, desires, and aspirations instead of the method of assessing the market's real ability to do anything above. In this way, in the market environment, you have a deadly combination of the market, which forces you to deal with difficult personal issues to survive. An event that generates information in various forms which can be used to support any illusion, distortion, or expectation, so it becomes easy to avoid dealing with these potentially painful issues. Also, this event continues until you compromise with whatever you have inside you to end it, until your brokerage firm ends your position. You are the only person who can stop it. Besides many other factors, to be a consistent, successful trader, your goal is to learn how the market tells you what it can do in the future and how much is enough. It is extremely difficult when you think that there is no relationship between what the market can do in the future and your personal belief system about what it means to lose, what it means to be wrong. Mark hears many readers telling themselves, "I understand the issues of loss, being wrong, and greed, but where does revenge come from?" It can be best explained by going back to the example of gambling. In gambling, you can only lose what you decide to risk. You bet money, and it is difficult not to accept the responsibility of any loss. Although as a trader, you can easily be much more than you wanted to risk. This can be based on your inability to understand the possibility or the inability to execute a trade to get out of your position, or a combination of both. It may be that you are basically ready to take the responsibility of the risk you wanted to take in a trade. Although you wanted to risk so much, it will not be so easy to take the responsibility of losing more than that. This is where the factor of revenge comes into play. If you don't take responsibility for what you have lost, then who or what can you blame? Of course, the market, because the market has taken your money. If the market has taken more than your original intention of taking risk, then you will probably feel compelled to get it back. For example, is 10 ticks profit in the trade that you are in at present enough, when you lost 20 ticks in the previous trade? Then it may be that the market is giving a very clear signal to the objective observer that where the price is now, only this is left, and the most possibility of success is to take profit now. If you lost 20 ticks in the previous trade, and you only wish to take a risk of 5, and the market is now offering you 10, then are you going to take it? If you believe in coming back, 10 ticks will not be enough. You will need at least 15, and it would be better to have 20 ticks to complete it. Your last trade clearly has no relation to the current capacity of the market at any time. When you feel compelled to come back, it puts you in an opposite relation with the market. The market becomes your competitor. You become against it instead of keeping up with it. The market cannot snatch what you do not allow.
If you have lost money or lost more than the purpose of taking risk, then you have your money. But revenge creates an opposite with you. If you are the person who gives money to the market, then you are also the person who gives money to yourself from the market. If you are angry with yourself for letting the previous trade go out of hand so much, then the opportunity that the market is offering you now as an opportunity will not be enough. From a psychological perspective, you will not take a chance for profit or otherwise because you did not think the last trade was right. In reality, you will keep yourself away from the present or next opportunity to punish yourself for the previous mistake. In reality, you cannot return to the market, and the belief in revenge allows you to return to yourself. There's a direct relationship between your ability to let the market tell you what it is likely to do in the future, and to what extent you free yourself from the negative effects of any idea about losing, being wrong, and taking revenge from the market, or become aware of this relationship through such books. In any case, until those who find it out, they have usually caused so much psychological damage to themselves that it adds a more difficult dimension to the process of becoming successful. This is the main reason why the areas of personal transformation have to be addressed in such depth in this book. You need to know if there is any damage, how to identify it, and most importantly, how to free yourself from it. So now we have learned about the market's movement in Chapter 5 of the book. In the next episode, we will learn about the market's structure in Chapter 6 of the book. If you like this effort of mine, please let me know by commenting, like it, and be sure to share it with at least 4 of your friends on social media. Thank you. See you in the next knowledge-filled episode of HindiAudiobook.com. Have a good day. In this episode of the Hindi Audiobook, we talk about Chapter 6 of the Discipline Trader book and why Mark Douglas has called the market an unstructured environment. Let's know. Chapter 6. The market is an unstructured environment. Unlike structured social activities, which have defined beginnings and endings and have strict rules to guide your behavior, the market environment is like a constantly flowing river which has no beginning or end and almost no structure. Once you jump into the river, it can change its course at any moment. Suppose when you jumped in, the river was flowing north. If you are already inside it, you have the option of increasing or decreasing the force applied at any time. There is no rule that prevents you from getting out at any time to change your desire to flow in the direction you want with the market, or you can stay out. The market just keeps going. In a structured and unlimited environment, it is necessary to create rules to guide your behavior. You have to create definitions and give yourself a direction. Otherwise, you will get lost in a lot of possibilities. The big psychological problem here is that if you create your rules and act accordingly, you have to take full responsibility for your actions and their results. The more responsibility you accept, the more you cannot transfer it to the market and become its victim. A common trader will do anything to avoid creating definitions and rules because he does not want to take responsibility for the results of his trades. If he really knows what he is going to do and in what circumstances, he will have something to measure his performance through which he can be accountable to himself. This is exactly the thing that most traders do not want. Instead, they prefer to keep their relationship with the market a little mysterious. This creates a real psychological conflict for traders, because the only way to learn to trade effectively is to create a structure and hold yourself accountable. But when things are not satisfactory, there is no direct relationship between the cause and its result to avoid responsibility.
If he loses money, he can blame the market, which is clearly very acceptable behavior among traders because many of them do so. The logical or illogical explanation of the individual's role in collective behavior will be determined later, that is, after the information from the unanimous opinion of the group. In this way, he can maintain the illusion of being logical and responsible, and whatever has happened to him has also happened to many other traders, so at least he knows that he is not alone, which creates a feeling of friendship among competitors. Most people outside the trade think that traders are strict people, which associates them with energetic types of characteristics, such as being decisive and firm. Most outsiders will be surprised to know that apart from a small group of these successful traders, the rest of the people come in a group who have no information at any time about what they are going to do, or do not even know what they are doing, they are just doing something. If you specifically ask them to tell you how they earn money or how they lose money, they cannot tell you. Also, as a group, traders are extremely indecisive and impatient.
It is not very difficult to determine why. If you believe that in general the structure of the mind of that trader is one step away from uncontrolled panic, organizing and creating a structure is a clear solution to many psychological problems that a common trader puts on himself, but it will also force him to cross that psychological boundary line in the scope of accountability and responsibility. In addition to completely denying to create a trade plan, most traders try very hard to maintain as much psychological distance as possible between what they do and the results of their work. Mark knows many traders who can analyze the market very well themselves, but still take the opinion of other traders about what to do and then take those trades instead of their own trades, only for the reason that if the trade does not go well and a better result is obtained than sticking to their own analysis. There are many flow traders who trade hundreds of contracts in a day. Although they have to record each of their trades on a trading card, they do not keep a proper account of their pure trading conditions, claiming that they get too busy or they have made a wrong addition. At the end of a day, they count their cards with deep concern, hoping or praying to some invisible force that they are flat. Clearly, if they were so worried, the simple solution to their problem is to just trade at a volume level, because if they keep an eye on their conditions, they will eventually have to take responsibility for what happens. What if they unknowingly reach a pure long position at the end of the day, and the market opens a few ticks above the next morning? In this way, the invisible market force has blessed these traders with a winning position, or vice versa. If the market opens down, can they always blame someone else for their bad luck? Maybe their lucky tie was mistakenly sent to the dry cleaners, or they crossed 3 red lights continuously on the way to the exchange. Any reason or excuse for changing responsibility will work. These reasons can range from the most excellent academic jargon to the most superstitious beliefs. But in short, they all focus on blaming themselves for unsatisfactory results.
To create a plan, you have to anticipate some events related to the depth of your plan. When you plan your trades in advance, you use your perspective and creative ability about the future. Under no circumstances does it depend on your plan and your ability to follow it. And so if things don't work, it's difficult to transfer responsibility and blame elsewhere. Until a trader understands the market's behavior well enough to know what he's going to do and in which market conditions he is going to do it, but if at the same time he is too attracted to action and opportunity, he knows what he should do. What do you think? What will a common trader do when faced with this dilemma? He will follow the leader by arguing that everyone is doing something. Also, all these people are waving their hands and shouting. They cannot be as scared and unknown as he is, so they know what they're doing, or at least know more than him. If they do what they do, or even better, if they identify the successful trader and do what he does, they can also earn money. This kind of argument creates a difficult mentality, where most people are looking for direction, believing that everyone else should know something that they do not know. Otherwise, why are they doing something? This collective mentality in a group is very unstable, where a key trader can start a continuous chain reaction where everyone imitates everyone.